By popular demand, we are going to do a little bit different of a video today. As you can see, I'm already sharing the screen. We're going to go a little more technical than we normally do. Some of you were on my Instagram and you asked to see this video because you saw me trying on an Audemars Piguet watch in Beverly Hills, and you heard about me talk about how there's a 3-year waiting period. So if I want to buy an AP watch right now from the store in Beverly Hills, I have to get on a waiting period that's going to be about 3 years for the specific watch that I tried on. Visit my Instagram, cm.carbone, and you can see what I'm talking about. But that causes what's called a supply suffocation. So if I bought an AP watch today for $41,000, I could go on the secondary market and I could list it for $80,000 and I could make almost double my profit right away. And the reason why is there's more demand than there is supply. And this is important to know because supply and demand is essentially what drives up the price of a stock or down the price of a stock. So a simple analogy that I like to tell people, just imagine you're in a cul-de-sac in a neighborhood and it's a very warm summer day. Right now it's like 110 degrees in Santa Clarita, but just imagine a little girl opens up a lemonade stand. And that lemonade stand offers really good, super cold lemonade on a very hot day. And she's the only stand on the block that's offering these cold refreshments. And let's say there's a line down the block because it's very hot and all the neighbors and all the kids and all the other people that are passing through, they want this lemonade. So they're going to wait in line. And since there's no competition, and since she's the only one selling lemonade, she can pretty much name her price, right? It's pretty much a given. So if she has 5 glasses of lemonade left and there's 50 people in line, she can raise the price per glass 5 times, 10 times, and because there's very little supply and there's a lot of demand, she could probably get a lot more money per glass than what she was selling it for when there was less supply, or I'm sorry, more supply and less demand. And that's essentially what happens with a stock. That's what happens with the price of Bitcoin that causes the price to go up and down. So you can see on the screen right here, so this is what's called an order book. Now I'm using Kraken Pro so you can see my order book, but this order book shows what's called a bid and an ask. So if I am, let's say that I have a Bitcoin and I want to sell it. And I'm like, okay, I bought it for $25,000, let's say 5 months ago, whatever the case may be. And I want to sell a Bitcoin for $32,000. Okay, that's more than what it's going for right now. So I'm saying, okay, I want to sell it for $32,000. Now let's say that somebody else wants to buy Bitcoin for $28,000. Okay, you're going to have the order book, a bid and ask, one on one side, the other on the other side. So that's where you see right here all the reds and the greens. Now the market price is where the bids and the ask start to meet right in the middle. Okay, so when the market price meets in the middle, let's just say that I have 28,000 and I have 32,000, and then they start to meet in the middle, and then 30,000 is what the market price is. That's what causes the price to go up and down. Now, let's say a bunch of people start buying Bitcoin in that middle where the two intersect. And I'm not talking about one order on one side, one order on the other. You can see on the screen right here that there is tons of orders, hundreds of thousands of orders. Okay. And just because you bid for somebody to buy your Bitcoin at $32,000 doesn't mean that they're going to. And just because you want to buy a Bitcoin at 28,000 doesn't mean you're going to get it. But what happens is all these orders fill up the order book, and then the market price is where they meet in the middle. And that's what you're able to buy right then and there on the spot. So this is how a stock goes up or down. Now, if there's more bids than asks, then you're going to see, like, if more people are buying Bitcoin and each order is being filled, then that's going to cause the price to eventually go up. So if there's more buyers in this order book than there are sellers, then the price of Bitcoin is going to continually go up. But on the flip side, if there's more sellers than there are buyers, then the price of Bitcoin is going to go down. But this is what determines, and you guys can see it right in front of you with your own two eyes, is what determines the price fluctuations of a stock, an asset, real estate, anything. Is an order book has buyers and it has sellers. And if there's more buyers than there are sellers, then the price goes up. If there's more sellers than there are buyers, then the price goes down. It's really that simple. Now, I'm going to go ahead and increase the screen a little bit here. But how does that relate to Bitcoin? So how does mining affect this order book that you just saw? Well, it's very simple. Now, I've told this 1,000 times. I'll get a little more technical for you guys if you'd like. But Bitcoin mining is the creation of a new block of transactions. Okay, that's simple. It's so there was a term called the Genesis block. So that means in 2008, the Genesis block was the first block of Bitcoin mining to occur, and that produced the first 50 Bitcoin. Okay, so what that means is Bitcoin had no monetary value at that time, and there was no Bitcoin in the market. And Satoshi Nakamoto, who mined the first block, created the first block, was set up the whole algorithm in hard code that once that block was created, he was rewarded 50 Bitcoin. So Bitcoin is not printed money. It is not created by anything other than Bitcoin mining. So that block was created. Now, what ends up happening is through that block is it is filled with transactions. So that Bitcoin block holds a certain, it has a certain amount of storage. And every 10 minutes, the transactions that occur on the Bitcoin blockchain fill this block up. Now, once that block is filled, then mining happens and a creation of a new block is done right after. I've done this in one of my previous videos. But in order to create a new block, a miner, which usually is a high-powered computer, currently they use something called a application-specific and integrated computer. It's ASIC. But a miner creates a new block and they're rewarded in Bitcoin. So from 2008 to 2012, each miner was rewarded 50 Bitcoin. And this happened every 10 minutes. And then the halving occurred, where the amount of Bitcoin that was rewarded to a miner for solving the algorithm and creating a new block where transactions could be filled, they were rewarded half the amount of Bitcoin. So it went from 50 Bitcoin per block up until 2012 to 25. So until 2016, the Bitcoin rewards were 25 per block. In 2016, it was cut in half again to 12 and a half up until 2020. Then the halving occurred. And then again, it went from 12 and a half to 6.25. And the next halving in April of next year will be 3.125. Okay, I didn't want to get crazy technical on this because I already covered this in another video and I don't want to bore you guys. But how does that relate to the AP watch that I was talking about in my Instagram video? Well, it's very simple. So if there is less Bitcoin being produced every time a halving event occurs, I want you to think back to the order book that I was talking about at the very beginning of this video. If there's more buyers than there are sellers, the price of Bitcoin will go up. So if the amount of Bitcoin that is being rewarded by miners and is flooding the market, if that is getting less and less and less every 4 years because of the halving event, then what do you think is going to happen to that order book? It's very simple. Over time, there's going to be more buyers than there are sellers because there's going to be less Bitcoin on the market. All right, that is how an order book works. That's how supply and demand works. And that's how the price of something is agreed upon on an exchange. This is how the cost of Apple is determined on the New York Stock Exchange. There's an order book and there's buyers and there's sellers. Okay, some people place what's called a limit order, and that means they bought Apple at 150 and they want to put a limit order that they're going to sell it when it gets to 200. That's going to go on the order book. Some people bought Apple at 100 and they want to sell it at 160. That goes on the other side of the order book. But these order books are what create demand in the marketplace, and it determines the price of an asset. So anytime somebody's referring to Bitcoin and they say, what's the price of Bitcoin going to be? I don't know what the price of Bitcoin is going to be in the future, but I do know it doesn't take a genius to realize that a blockchain that has never been hacked, that is truly decentralized, that actually has an algorithm that's hard coded from the beginning to create a deflationary monetary policy until the year 2140, because that's when the last of the Bitcoin will be mined. It doesn't take a genius to realize that if the demand stays constant or if the demand goes up, but the amount of available Bitcoin on an order book goes down, what's going to happen to the price? It's simple as that. But it is important to know who determines the price of Bitcoin. It's the market. Okay, it's that order book. That's what determines the price of Bitcoin, is how many buyers are there and how many sellers are there, and where does that meet in the middle? Because that's what you can buy it at currently. And as buyers and sellers outweigh each other, that's what determines whether that market price is going to go up or down on the spot. Okay, AP, it's so funny. When I was talking to the sales guy at AP yesterday, he told me that there's only like 10,000 to 15,000 APs that are actually produced every single year. That's not a lot. That's not a lot of watches. Okay, so that means if there are 50,000 people in the world that are wanting to buy an AP watch and there's only 15,000 that are being produced every year, the amount of buyers and sellers is off, which causes the price to go up. Richard Mille, which I stopped in their store yesterday too, and they only had one watch for sale. It was for over seven figures. It was over $1 million. They only had one for sale in there, one on display, and they only produce 6,000 per year because they're hand made. And some of these watches take a long time to make because the craftsmanship is so unique and complex. But if 6,000 watches for Richard Mille are being made every year, but 60,000 people want to buy, that's why the secondary watch market is just exploding right now, mainly because that order book, they might not have an official order book, but the order book has their more buyers than there are sellers. Okay, I hope that helps, guys. If you have any questions, drop a comment below. Otherwise, let's buy some Bitcoin and just hold it. Zoom out. Don't be so concerned about the price fluctuations today. Be more concerned about what it's going to be in 2032 when the amount of Bitcoin that's being rewarded to a miner for the first time ever will fall below 1 per block. It's like 0.77 or something like that. So let's have fun, guys, and we'll see you in the next video.